Bloomberg Audio Studios. Podcasts, radio, news.
Joining us now is a man known for his bearish best known for it. One of the few last standing activist short sellers really left out there. That is Carson, founder and CIO of Muddy Waters Capital. And would love to start with you on the environment here for a minute, because there is a lot of conversation about how difficult it can be to short in this market, particularly whether you call it a melt up, whether you call it a bull market. You certainly see even the unprofitable names or even some of the potentially troubled names moving higher. How do you feel?
It's never been a good time to be a short seller, I suppose. But a lot of what drives stocks these days, and your previous guest was talking about factors. And that's the thing. It's really so much of what moves stocks is really just flows into and out of index funds. So mainly into index funds. So as a short seller, you have to be attuned to that and really have to stay away from names that have significant passive ownership, because effectively that just shrinks the supply of the stock. And when you have inflows into those passive funds, they will buy those at any price. So that is something that has warped the environment and caused a disconnect between fundamentals and the prices of the stocks.
Carson, that's really interesting. We heard something similar from David Einhorn talking about how these passive flows have sort of just fundamentally changed markets. I do want to bring you some sound from our interview with Jim Chanos a month ago on the close. He had some interesting things to say about the state of short selling.
I've called this the golden age of fraud. So there's just so many companies, so many companies now that are playing games, that are trying to take advantage of investors. So we need short sellers more than ever.
The golden age of fraud, of course, Jim Chanos' perspective that we need short sellers more than ever. But talk to me about the fundraising environment. I mean, is there investor demand for those short sellers?
Well, when I began raising money, so I was first an activist short seller, didn't have a fund, and then we launched. And my initial conversations, so we're talking 2014, 2015, were a lot of them flowed in the following way, which is, we're concerned about valuations, we're concerned about the market, we want short exposure, but we just don't want to lose money when the market goes up. And it's like, well, you can't really have it both ways, guys. And since then, the environment's only gotten worse. I mean, Jim has shut down his hedge funds because, investors don't want to pay the price for that insurance policy that is your traditional short selling strategy. They don't care about alpha. And, I'd say that also one of the things, to Jim's point about the golden age of fraud, yes, there are more companies playing more games. A lot of them are in the gray zone. You don't know whether it's over the line or not. So they're not going to get prosecuted in this environment. And some are over the line. But, I think that 2013 was a tipping point where on the long side, investors stopped being remunerated for caring about risk. And it became just about buying narrative. And so the long side investors who didn't make that transition, who still cared about risk, well, they became the butt of jokes or were derided as value investors. And I think that that's one of the transitions that David Einhorn went through, was realizing that you have to look at things differently than you used to. So that's the problem. Like, yes, the market needs more short sellers more than ever, given the amount of games that are being played. But if the long side doesn't care, then this can continue until it doesn't, basically.
So Carson, that's the sort of market's explanation. I wonder about the political issue, because during the Biden administration, the Department of Justice and the SEC have opened investigations into short sellers, accusing them of market manipulation. You would think that the Democrats should appreciate, speaking truth to power, holding corporate America accountable, pulling back the curtain and showing that it's not a wizard, it's a dude back there, So Do you expect anything different if we were to have a second Trump administration, or do all politicians hate short sellers?
Well, it's interesting because just small correction, Ed, nobody's been accused of market manipulation yet. So to be fair.
No, just investigations, though, right, have been open.
Yeah, so I mean, look, we received subpoenas and, search warrants back in 2021, which, that's a day that, I'm sure my then 8-year-old son will never forget. I've got a real personal issue with this, but I think one of the things that I realized was at the SEC, when they were making these cases in 2010 to 2013-ish, based on work that activist short sellers had done, well, a lot of those people left the agency, and they now bill $2,300 an hour working for big law firms. So I'm not sure that the agency has much of an institutional memory of how helpful short sellers have been to it. Mm-hmm. And when you look on the whistleblower side, there's that SEC whistleblower program. It seems that the SEC is now trying to actually, contrary to the law, there's no law that states you're differently situated if you're a short seller versus company insider who's blowing the whistle. But it seems like the SEC is trying to make it harder for whistleblowers to actually get paid when the SEC has recoveries. So right. I chalk it up to no institutional memory, number one. And number two, there's this populism, right? There's political populism, but that's infiltrated the markets. Mm-hmm. And I think Elon Musk is really the first to recognize that in the markets and use that to push Tesla up. But I think that part of that populist message, it's easy to demonize short sellers right. as part of the populist message and somehow call us the suits. Well, that was a really weird moment in 21 when that started happening.
Well, Carson, wrapping it all together, I mean, you think about the regulatory overhang, the political demonization, it sounds like you'd call it, of short sellers, and then the fact that you have those market dynamics, all of that passive money coming in. I mean, do you see the short selling industry shrinking from here? What's the outlook?
Well, you have to differentiate the traditional short sellers who are not talking about the stocks they're short, and they're typically going to be short 50 to 80 names for fundamental reasons, melting ice cubes from what we do, which is we look for companies that have been generally, gravely misrepresenting the information they give to investors, if not outright lying. Mm-hmm. I think the former, that's a very difficult business right now because, it's just, there's this inclination to buy narratives, and allocators don't really want to lose money waiting for, paying for that insurance policy. For what we do, there's still, as Jim makes clear, right, there are plenty of companies that are problematic. The question always is whether investor apathy, investors in a given name, whether they're so apathetic that the problems that we find won't matter to them. And Carson, when you have an environment in which there's no enforcement, that contributes to it.
Carson, I want to switch gears a little bit and talk about sectors, because you have been clearly targeting certain areas, and one of very high interest to investors right now, that is the commercial real estate market. You've had this short when it comes to BXMT, Blackstone's mortgage trust, and it has been down about 10% on the year. Clearly you've made some money, but to what end are you looking to short this stock? They say they have $1.7 billion of liquidity. How much further are you going to go here?
Well, our thesis from when we unveiled it in December of last year is that in the second half of this year, BXMT is going to cut the dividend. So we're generally not forward-looking in what we do, but our BXMT short is different. And it was based on this information asymmetry. We got a hold of CLO data, so CLO loan data, which that's apparently emblematic of BXMT's CLOs of what's on BXMT's balance sheet. So, I mean, a lot of these loans are in trouble. BXMT has not trued them up in terms of the risk ratings. So we believe that as more and more of these loans are allowed to pay in kind, that in the second half of this year, BXMT is going to have to cut the dividend. So that's what we're playing for in that short.
So if you think about what's happening now and this idea that you could see an interest rate cut, does that make the situation simpler for BXMT and other REITs? Do you think that this is a trade that you would continue into other areas, this higher for longer pressure on loan books trade?
So in December, when we went public with this, I mean, our view was that unless there were a roughly 300 basis point drop in SOFR within the next month or two, the BXMT would have to cut the dividend. So we've seen no decline. We've seen no decrease in SOFR, and maybe you're going to get a 25 basis point cut, before the end of the year, maybe 50 basis points. It doesn't matter. In our view, because the problem is the borrowers had been protected from the interest rate rises because they put into place these, they call rate caps. They're effectively interest rate swaps. And as those swaps burned off last year and are burning off this year, now they're exposed to the much higher interest rates. So that's what we think is the straw that's going to break the camel's back here.
What do you think about banks? Sonali's had a banner day with the big ones. Are there any that you would short, especially those that are exposed a lot to commercial real estate or multifamily?
Man, well, look, certainly there are some regional banks that could be interesting. In the past, in 2016, we were short bank OZK, which has a lot of exposure basically to niche CRE, doing construction lending. Now, at that time, it was also partly to say, look, this is trading at 2.5 times book because everybody thinks there's no risk here. It's such a great bank. I'm not current on that one, but if one were inclined, I would look at that.
All right, Carson, that's a good place to leave it. Unfortunately, we're up against the clock. Have to have you back on soon. That is Carson Block of Muddy Waters Capital, and this is Bloomberg.